Hey folks, it's Dr. Jeff Camarda with kind of a long video on Camarda's overall investment philosophy. This is our basic investment philosophy. Subsequent videos will talk about the philosophies for Ames and for Caesar. So I'm going to begin with the executive summary, and if you get a little bit tired, feel free just to stop watching the video after that. You'll get the gist of it. All right, so the executive summary for our overall investment philosophy is we seek long-term superior performance with lower risk. What rational investor would want to do that? We're basing our strategies on academic research and what are generally accepted best practice principles. And there are three hard Camarda guidelines. Number one, diversification, spreading exposure over many different investments with the goal of reducing risk of loss and increasing chances of getting some outstanding performance. Number two, buying right. Seeking high quality at discount prices builds in a downside cushion and gives an upside bias for patient investors. And number three, ignoring media hype and short-term trends. It avoids performance chasing and lets us focus on long-term probabilities. So instead of playing investment games of chance, Camarda portfolios target long-term financial success based on best practices and probabilities. And it's designed to help enable our clients to build the wealth that they need and want for retirement and other goals. Not to have a couple of flash in the pan winning hands, but a long-term strategy to build wealth to match whatever it is that you want to do in life. Wealth is a resource to enable what you want to do in life, right? So concentrating on overall portfolio performance really is key instead of individual investment results is a really important way to remain successful. At any given point in time, some portfolio pieces will inevitably outperform others. And if you just focus on the winners and curse the losers, it usually drives you to make decisions that ultimately harm you. So look at the overall portfolio results, not the individual pieces. The Camarda managed portfolios seek long-term superior performance with lower risk. And this is getting into the long-winded part, so if you've had enough, see you next time. We study academic research and principles believed to have produced better investment results. In the quest for better and safer returns over time, we feel again there are three critical guidelines to follow. Diversification. Spreading investments over multiple opportunities reduces the risk of any one poor performer contributing to unacceptable losses and increases the chances of acquiring outstanding performers to grow wealth. Number two, buying right, taking a Warren Buffett-like approach. We believe that investing in securities that appear to be undervalued will produce better returns with less risk in the end. Value investing has the strongest academic evidence of producing superior long-term results. If you can wait, it requires patience. Sometimes it's frustrating. But as with most things, results usually don't sprout overnight. And a watch pot not only doesn't boil, but can induce a lot of anxiety and poor decisions. I shade number crunching investing, really getting into the numbers and the balance sheets, the cash flows and that kind of stuff, can be less sexy and intuitively appealing than get-rich-quick methods like market timing, but can ultimately be much more successful in getting or keeping you rich. Ignoring short-term trends and media noise, and recent trends could be a contrary indicator. What did really well recently tends not to do well going forward, and luckily got overvalued in the recent run-up. Also, it's important to remember that financial media are businesses paid to get your attention. Pay attention to me, not to educate you. They tend toward sensationalist, shallow, this just in, better watch now messages that sell advertising, but can interfere with more comprehensive and wiser, more cool-headed views of the world, which can induce poor decisions. So the Camarda strategies are designed to help facilitate clients' long-term financial goals. The objective of the portfolio is to provide the wealth that clients need and want to fund their retirement and their financial goals effectively. To accomplish this, we take the long view instead of just trying to beat the market over the short term. Although this does happen sometimes, but it's not the primary objective. Rather, our intention is to provide the building blocks for a prudent and effective long-term investment plan, customized for each client and designed to meet their investment goals and financial planning needs over a client's whole life planning cycles. We think this approach makes a lot more sense than chasing performance and making frequent knee-jerk changes at the risk of big losses and unmet goals. In the end, we believe that sticking with well-designed and disciplined plans will produce much better performance results. And finally, again, it's important to stress the primary reason for diversification. Not every investment will do well, at least not at the same time. Expecting to get all winners is just too good to be true and unrealistic. It just doesn't happen. In a diversified portfolio by design, and at any given time, since the winners and losers tend to change over time, the better performers carry the poorer performance in contributing to overall portfolio returns. That's expected. Investors who focus on overall portfolio results instead of individual stock or fund results should not only have more peace of mind, but will likely achieve better results since they can understand the big picture better and should be less prone to make poor decisions like selling losers at the worst possible time, which can really harm their wealth. I'm sorry that was so long-winded, but hopefully it was informative. And until next time, we'll talk about the specific philosophies for Ames and for Caesar and some other stuff. Thanks so much for watching. This is Jeff Camarda.